So she deducted, or they deducted when her husband was alive, at a 24% rate. And even though she's in the 22% bracket, she's basically paying half of that in actual tax based on her situation. Pretty remarkable. Real Cash Flow King with you today, and in today's episode we have Rethinking Roth. Thanks so much for tuning into the show. As always, we really appreciate it. A couple quick announcements before we get into today's episode. First, I went ahead and pulled the link from the show notes on our merch. I'm not going to name the vendor that we were using because I don't want to give them any publicity whatsoever, even though in my opinion they fucking suck. I put out, if any of you saw it back when the link was still live, like a little puzzle with Real Talk Personal Finance, like a little jigsaw puzzle thing and some other newer items. And I actually ordered one of them. It's pretty expensive actually, and it never showed up. And somehow the post office claims that they delivered it, although I never received it. And fortunately was able to go ahead and file a dispute and get my money back, but the assholes over at the company that shipped the stuff out didn't want to resend it to me and pretty much just stopped responding to me. So I'm in the process of closing the account for the podcast with them and going ahead and getting a new company to do our merch through. Spoiler alert for Cube Crusher, if you're listening, I thought they were going to let me send 3 different samples out. I was going to send one to myself, one to you, and one to the Big D. However, once I had your name in there first, it was actually you could do 3 products once a month as a sample to yourself, not 3 different orders for samples per month. So anyway, you'll be getting a nice winter hat with Real Talk Personal Finance on there and a little gift message. So I hope you enjoy that when you receive it. So as soon as we get the new vendor up and running and have a couple products ready to go, we will be sure to make that announcement on the show. Thanks for your patience. The October 2025 Vegas meetup has concluded. We had a fantastic time, so hopefully next time you all might be able to join us and we'll have an even better time. Okay, and then finally, as a segue into today's episode, I've been wanting to record this for a while. We've done shows before on pre-tax versus Roth. We had one with Cube Crusher and Cold Brew. I know for sure we had that one. I'm not sure if we've done any additional ones or not. Sometimes we talk about it and it's sort of intertwined within a particular episode. But this is something I've been thinking a lot about, and I do think a lot about, and I was going to wait until I finished reading what I thought was an excellent book. I will link to that book in the show notes if you guys want to pick it up. And it talks a lot about a lot of different things. Most of it is on early retirement and early retirement strategies from a tax planning standpoint. However, there is some conversation in there, and there's some other topics too, but one of the big ones is, in one of the centralized themes, in my opinion, is it really makes you rethink doing Roth contributions. Now, before you send me fucking hate mail, I am not, just to be crystal clear, I am not talking about rethinking or questioning Roth IRAs. I still am 100% on board. That's one of the best accounts, in my opinion, that somebody could have. 100% on board with making Roth IRA or backdoor Roth IRA contributions. And as you'll see as we get a little bit further into the episode, that's also true from the authors of this particular book. However, what I am referring to, and we'll talk through this with a couple of examples that I'm actually going to pull straight from the book. So, we'll get into that here in a little bit. I am talking about rethinking Roth contributions to employer-sponsored plans, or technically what are called designated Roth accounts. Things like a Roth 401k or a Roth 403b and the like. Plans that you contribute to through your workplace at your employer, where you have the ability to choose whether or not you want to make a traditional pre-tax contribution, which, as you'll see, is very much in favor, versus making a Roth contribution, which a lot of plans, seemingly more and more plans, are allowing for now, and really questioning which of those two you should be doing. Now, as I've said on the show many times, and this is true for every single episode, we do not give advice. We are here for education, for entertainment, to cut up and have a couple laughs, but hopefully give you some things to think about in the process. Everybody's situation is going to be different. I'm going to make some statements today. I'm going to say some things today. I'm going to go through a couple of examples in the book today. And just because I say a certain thing or the book says a certain thing, that doesn't necessarily mean that that's a particular recommendation for you. We are not making any recommendations or providing any advice to anybody. So always consult your own professional. Okay. With that said, again, rethinking Roth employer-sponsored contributions and plans, especially for those that are somewhere in the middle. So I guess I'll start. I'm going to have some of my own commentary in here, my own thoughts. I'm going to intertwine with some things from the book, go through a couple of examples in the book, and then we'll wrap up with some other areas of agreement based on what they're describing and talking about in the book, and then what I personally and professionally think and do. And then we'll call it a day. All right. So as far as pre-tax versus Roth, right? This is an age-old debate. When we're talking about this, I'm talking about this in the context of your employer-sponsored retirement plan. So just think like your 401k at work, okay? Generally speaking, and there's a lot of different, this is what makes personal finance so interesting and so personal. There's a lot of different opinions out there. There's an excellent article for those that want to look it up. It's from Michael Kitces. It's a little bit older at this point, several years old. But he talks about a concept called tax rate equilibrium. And there is a particular photo in that white paper that shows these different buckets. And based on somebody's estimated marginal federal tax rate, you can generally make a statement as to whether or not it would typically make more sense, all else being equal, for that individual to make a pre-tax versus a Roth contribution to a retirement plan at work. So on the lower two brackets, the 10 and the 12% marginal federal brackets, typically that would indicate that somebody may want to go ahead and make Roth contributions. And in some cases, that could still be true. I actually have an example of a client where that is going to be the case for her, and I would not deviate in terms of my advice in her particular situation. However, there's going to be other people where your mileage may vary. But 10 and 12% federal typically is going to be indicative of and supportive of making Roth contributions, according to Kitces' piece anyway. If you get up into the 32 and above, so 32, 35, 37%, higher marginal federal brackets, those are typically going to be where you would want to make a traditional pre-tax contribution to an employer-sponsored plan. And then, as you might imagine, in the middle are the 22 and 24% marginal federal brackets, which is pretty much for everybody else, and that's the vast majority of people. You could make an argument essentially either way. And that's kind of always the way that I treated it, and I still would say to this day that I could make that argument either way depending on a lot of different factors. And what makes this a little bit more, not really complicated, but this particular book, again, focuses on early retirement, whatever that means to you, but typically before traditional retirement age. And so if you are on the financial independence, retire early, the FIRE, or the financial independence, the FI, and there's so many different fucking acronyms for it now, but if you think you're going to retire before your typical quote-unquote normal retirement age that everybody likes to talk about, and again, you ask different people, they're going to give you different ages, whether that's the age they can collect a pension if they have one, whether that's their full retirement age for Social Security benefits, whether that's, until they can't work anymore, whatever's normal to them, right? Very subjective. But for those that are, going to hopefully retire at an earlier age than most, I would say that tips the scales even more so in favor of doing pre-tax contributions. For those that are going to work for quite some time, and especially, and there's not going to be that many people, but especially if somebody has a traditional defined benefit pension plan where your pension is generally going to start right away, not always, there's going to be some nuance and differences there, but if you're going to have a situation like that, and especially like I have a client where that's her situation and she's actually in the 12% marginal federal bracket, I can make an argument for Roth there. But there's always going to be one-off situations, right? But I guess the overwhelming theme in the book is and what I got out of it is you really want to rethink making Roth contributions for most people, especially if you're in the 22% federal bracket or above. 22 and 24 again is where most people sit. You really want to rethink making Roth contributions, and more than likely you're going to want to make pre-tax contributions to those plans. Again, not advice, but we will go through some examples where we kind of walk through what that could look like and some reasons why. So, and I'll be the first to say, I think Cube Crusher called me out on the show that we did with Cold Brew. And I made a comment about how at one point when I was single, I think I hit the 32% bracket at one point, and I was still doing Roth 401k contributions. And he said, yeah, you were a dum-dum. And looking back, if I could rewind the tape and make that change back to traditional pre-tax contributions for that time period, I absolutely would. So in hindsight, that, in my opinion, and based on my situation at the time, was definitely a mistake. But you can't go back and change that, so it is what it is. So nobody's perfect, no matter what. If you are contributing to anything, even if you hear this episode and you are doing Roth and realize maybe I shouldn't be, or you're doing pre-tax and realize, well, maybe I should be doing, or whatever you decide for yourself, the fact that you're contributing to anything in whatever capacity that you're contributing to it through, whatever method, whether that's pre-tax and or Roth, don't beat yourself up. There's always time and a chance to pivot, to make changes, to change what you're doing if you don't think it's what you should be doing. And you may listen to today's show and disagree with some of the things that I say, some of the things that are said in the book, and that's all good and well, totally fine, right? I'm never the type that's going to get upset if somebody disagrees with me. That's what makes personal finance personal, right? So don't worry about that. Now, one of the overarching things they talk about in this book is what they refer to as the compelling three. And we've talked about this on the show before. I think we did a show one time on, I think it was lifetime flexibility, the tax triangle, I think is what I called it. Lifetime financial flexibility and the importance of having different accounts and money in different areas. I think all that still holds true. But I think the biggest thing is going to be, where people get caught up is, what do I do with my plan at work? Do I do pre-tax or do I do Roth? And I think after today's show, you're going to take a really hard look at, if you're not doing it, considering pre-tax. So what they refer to as the compelling three, and I'm paraphrasing here. I took some notes on my phone, and I actually do have the book here. We're going to go through a couple of pages where I'm going to read some things verbatim and go through some examples for you. But they basically say, hey, look, go ahead and do a traditional pre-tax 401k contribution, which is going to generate some tax savings for you, right? Because you're putting the money in before taxes. And then take the money that you're saving by doing that on those taxes and make a Roth contribution, a Roth IRA specifically contribution, or if you're over the income limits, a backdoor Roth IRA contribution. We've done shows on that before, so go back in the archive if you're not sure what that is. And then finally, the third, that's the second, is the Roth IRA. And the third, which is, and I've talked about this before, even on the Millionaires Unveiled podcast, when I did my interview on there, and I made a comment about looking back, and if I could change some things, what would I change? And one of the things I talked about was not necessarily putting so much money into retirement accounts and having more in a non-retirement, liquid bucket, if you will. The third one is taxable brokerage accounts, or a non-retirement brokerage account. And when you say taxable brokerage, you almost want to put that in quotes. They talk a lot, and I'm not going to rehash it because we don't have time to get into all that right now in the book, about the ability to potentially generate long-term capital gains at, in many cases, a 0%, and in some cases also could be a little bit higher than that, could be 15% long-term capital gains rate. But the fact that you can, especially for early retirees, depending on how you set yourself up, generate long-term capital gains at 0%, at least for a few years, you almost want to put the taxable in the words taxable brokerage in quotations, because even though it's technically taxable, you might not actually pay any tax. And that's not going to work that way for everybody, but in general, it is a possibility. So that's their compelling three. Pre-tax contributions to your 401k saves you some tax money. And take that resulting tax savings and put it into a Roth IRA and a taxable brokerage account. That's pretty much the argument. And I can get on board with that because, again, it builds on what I talked about with the tax triangle and having flexibility in those different buckets, and how do you fund those different buckets. So I have no issue with any of that whatsoever. Now, what I'm going to do here, and this is going to seem a little weird because this book typically caters to those pursuing or considering tax planning in early retirement and how that works and what that looks like. I'm going to switch gears a little bit, and I'm going to flip over to one of the things, and this has been on my mind for years. This is also addressed by Michael Kitces in that article on tax rate equilibrium, what they talk about there. There is another gentleman who wrote The Simple Path to Wealth. His name is J.L. Collins, who has a certain opinion on this. And this is once again addressed with examples, which I think is phenomenal in this particular book that I'm going to go over here in just a moment. And that is the idea that, well, wait a minute, if I put, quote unquote, too much into pre-tax retirement accounts and I don't touch it and I leave it alone and I let those assets balloon, by the time I have to start taking RMDs or required minimum distributions, I'm going to put myself in a higher marginal tax bracket that I can never get out of, even though I may not need the money, because I have to take all this money out of this pre-tax account because of these RMDs, right? That's pretty much the premise of it. And one thing that I mentioned that I've said before in previous shows was about how looking at what's going on with Secure Act and Secure Act 2.0 and these RMD ages, or technically what's considered the RBD, the required beginning date, which is a fancy way to say, hey, how old do I have to be before the IRS basically comes knocking and says, hey, asshole, we want some of our tax money out of this pre-tax account. So you have to begin withdrawing a certain amount, right? Your required amount, your minimum amount, you have to take a distribution, hence RMD, required minimum distribution, from your pre-tax retirement account, okay? And that age has changed over time, as we've talked about in previous shows. So way back in the day, don't ask me where they got the half from, just like with 59 and a half, who the fuck knows. But the number, the age, the magic number, as I like to call it, was 70 and a half. That was the age that you had to begin taking RMDs. Now, for those geeks out there that are screaming at their phone or, whatever, as you're listening to this saying, well, wait a minute, technically you didn't have to do that because the first year's RMD can be delayed up until anytime before April 1st of the following year. Yeah, I get that, okay? But let's just cut the shit for a second and just get realistic and say, look, most people, for several reasons, are going to take the RMD the first year that they have to take the RMD. They're not going to delay it until the second year because then they have to take it twice. And if you really want to have that argument, email the show, realtalkpersonalfinance@gmail.com, and we'll have some fun. But the age was 70 and a half. Then, for some people, it went to age 72. Now, technically, that age is age 73 that you have to start. And for anybody born in the year 1960 or later, that age is now 75. So what's happening? Well, they are pushing out the age at which you must begin your required minimum distributions. They are actually giving people more time. What does that mean? Well, one thing, in my opinion, that it means is you have more time now to plan. You have more time now to strategize. And it's not as bad, quote unquote, as it used to be. What are some other things that have happened with this OBBBA, right? Well, there's the senior deduction, as they're calling it, right? And you have your typical standard deduction, and then you have your, I believe it's age 65, you have an additional standard deduction. Now there's a special senior deduction that phases out at certain levels of income. So more and more now, it is becoming more and more tax-friendly, if you will, for folks that are a little bit older. And one of the points that they make in the book, and I think this has been made, just across the board, outside of the book, is that the last thing that politicians want to do, and we don't talk politics on this show. I'm not here to get political. I don't give a shit what anybody believes or not. That's your business. But from a political standpoint, the likelihood that tax rates are going to go up on retirees is very unlikely. And we've seen that firsthand with what's going on now, with the RMD age increasing, with these additional deductions, so on and so forth. What everybody seems to be worried about, and what everybody always talks about, and I've been guilty of this in the past myself, is, well, what about tax rates in general? What about, the financial shape of this country? They have to raise rates at some time, da-da-da-da-da-da. And maybe they do. Maybe they will. Maybe they won't, but maybe they will. However, just because the marginal federal rates go up doesn't necessarily mean that your specific individual tax rate that you actually pay will go up. And I think that's a foreign concept for a lot of people when you really think about it. The other thing, and they mentioned this in the book, and I appreciated this very much, was that when somebody is going to work and earning a paycheck, if you think about, and they didn't exactly say it this way, I'm kind of paraphrasing, I'm just trying to figure out a good way to explain this here on the podcast. But if you think about like all of your earnings, right? You're going to work and you're making money. Well, guess what? You're contributing, most likely, to a retirement account. Hopefully, you're saving money after you get paid, right? Whether that's a savings account or brokerage or whatever. You are paying payroll taxes. You oftentimes will have additional costs, things like commuting costs. Maybe you have a particular wardrobe you need to wear for work and you have a dry cleaning bill. Maybe you go out to lunches more often and you spend more money because you don't bring rice and beans in a fucking brown paper bag, right? So there could be some expenses and some things that are there that aren't necessarily going to be there in retirement, but you earn what you earn. If I think about, my earnings this year, do I need 100% of my earnings to live on? No, of course not. Does anybody? No, of course not. But you're earning whatever it is that you're earning. But when you're retired, and now you're getting income from different sources, whether you're drawing down assets, you're collecting a pension, you're collecting Social Security, whatever the case, living off savings, whatever the case might be, you are only drawing down to the extent of your expenses, right? You're not going to take out more than that. So if you were earning more than that in your working years, for the reasons I just mentioned and the way that all that is working, no pun intended, but in retirement, you're only drawing down to meet your needs, then conventional wisdom may not be all that far off when they say things like, well, you're only going to need X percentage of your final year salary in retirement. Well, that's not going to be the case for everybody, but for most people, I would venture to guess that's going to be true. And oh, by the way, going back to the idea in this book about how a lot of it's catered towards those in early retirement, one of the things they talk about is drawing down from a taxable brokerage account first, money that you have in a non-retirement investment account. Well, guess what? If you have to take withdrawals from that account, or let's say you built up some savings during your working years and you need to start to withdraw down from your savings, again, you're going to withdraw what you need to meet your living expenses in retirement. You're not going to take out more than that. So that in and of itself is probably less than the number that you were earning while you were working still. But also, when you make those withdrawals, not 100% of those withdrawals are taxable. Think about it. If you have money in your savings account right now and you go to the bank and you make a withdrawal, are you getting a tax bill? No. You might pay some taxes on interest income. You might get that 1099 INT for interest income that you've earned that you got to declare and pay taxes on next year's return. But if you go say, hey, I want to take $1,000 or $10,000 or whatever the number is out of a savings account, you're not getting a tax bill for that. Similarly, if you are going to take a withdrawal from a taxable brokerage account, and let's say over time, I'm making numbers up, over time, you invested, say, $50,000 into a particular security or multiple securities, and now, that's worth, and I'm making this up again, say $100,000, and you need to take a little bit of money out. Well, part of that, depending on how you structure your tax lots, and we're not going to get into all that, but depending on how you do it, more than likely, a portion of that is going to be gain, which, oh, by the way, could be long-term capital gains, and as I mentioned before, and as they mentioned in the book, could be as low as 0% tax. But a portion of that's probably also going to be what's called basis, or essentially your return of principal, which is not taxable. So if you look at it, and I'm kind of setting this up for these examples, but if you look at it from the standpoint of like, okay, I earn what I earn at my W-2 or whatever, earned income, and I get taxed on that, and yada, 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 and I have to take some and save some and invest some and pay payroll taxes and all this shit. And then I'm retired all of a sudden, and I'm like, well, wait a minute. I only have to take out what I need to meet my expenses. And then of the money that I'm taking out, which is already a lesser number, not all of that money is taxable, then the net result is what? You're probably going to pay lower tax. And everybody always says, pay tax when you pay less tax, right? Lower lifetime tax rate. That's essentially what everybody's looking for. And so when you think about things like that, it's like, that actually kind of sort of makes sense, or at least to me it does. So what I'm going to do now is go through several pages of this book. Again, there's some tables in here. I think they're the first ones that ever really put some numbers to this, which makes it a lot more user-friendly. So you can always pause or come back to this or read it on your own and go through it. This is going to be hard to do in an audio format, but I'm going to go ahead and skip to and read through a couple of examples. And what I'm going to be talking about now, as I mentioned, I'm going to flip over to the RMD part of the conversation. I know I just went back and forth, but now we're coming back to the RMD portion. And basically trying to address, is it really that big of a deal to make these large pre-tax contributions into these accounts for fear of RMDs later in life? That's essentially what we're trying to get at. Some would tell you yes, and historically I would probably tell you yes. Others would tell you no, and others, including the authors of this book, and I agree with them, especially for those that are going to do any sort of early retirement. To a greater extent, you should not be afraid of this. But even for those that aren't, even for those that were doing pre-tax and have built up, certain positions, here's what that could look like with these examples in retirement when they're much older. We're going to go through some numbers, and I think this will make a little bit more sense as we go through. All right. So forget about the early retirement part at this particular time. We're just going to talk RMDs, and we're going to talk about a couple of situations, and we're going to talk about what their tax bills could look like based on their income sources and what they have going on. And I'm going to go through two examples, and I think you'll see, especially on the second example, which is a scenario that I was kind of worried about, it's really not all that bad. And I think this will make more sense here in a moment. So here we go. All right. So on page 186, for anyone that picks up the book, and by the way, I'll put a link in the show notes for this if you want to pick up the book. I think it's excellent. It's I think it was list price was like $30. I think it's on sale right now for like $28 or something like that on Amazon. It talks about tackling required minimum distributions, and one of the questions they pose in here says, doesn't maxing out a traditional 401k lead to horrible required minimum distributions, or RMDs? And a lot of people, again, have probably heard that, thought that. I was one of them. I mentioned J.L. Collins before, who has written the book, The Simple Path to Wealth. And I'm quoting them in the book, who is quoting J.L. Collins, which says in one of his chapters, RMDs, the ugly surprise at the end of the tax-deferred rainbow, end quote. And so they're basically saying, hey, this is what this guy's saying. He's pretty well known in the financial independence community and pretty well respected. I think for anybody that's looking for a book on simplified ways to invest, and it's probably overly simplified, but I think it still holds merit. The Simple Path to Wealth by J.L. Collins is also an excellent book. We'll see if we can drop a link to that in the show notes as well. But they're saying, hey, not so fast, pal. We pretty much disagree with that. But they're not an ugly surprise. They're just tax rules to be navigated. So then they go through, and I'm not going to go through all this part, but they go over RMDs and how RMDs work and the different tables, and you can read through that if you're not familiar. That's fine. But now I'm going to skip over to the taxation of RMDs section on page 189 at the bottom here. It says, the taxation of RMDs may not be as burdensome as you might have expected before reading this book. In fact, RMDs often benefit from tax rate arbitrage. They're frequently taxed at lower federal income tax rates than the marginal rates that applied when the original 401k contributions were made. We'll walk through two examples to help you see how RMDs are actually taxed and whether the outcome is better or worse than expected. So I'm going to go through these examples now. First one. First, meet Estelle. She's a widow who turns 85 in 2025. On December 31st, 2024, her traditional IRA was worth $1 million. And then they go through, RMD table, blah, blah, blah. Her 2025 RMD is $62,500. Estelle also holds a domestic equity index fund worth $250,000 in a taxable account. And then it talks about it generates $3,400 of qualified dividend income, $200 of Section 199A dividends, $200 of other non-qualified dividends, yada, yada, yada. Okay, she also has $50,000 in a bank account producing $2,500 of interest income. Her Social Security income in 2025 is $36,000 a year, or $3,000 a month. Assume that she and her late husband made their traditional 401k contributions at a 24% marginal federal income tax rate. Now let's pause here for a second. One thing I don't think I talked about yet that is brought up quite a bit, and they talk about it a little bit in the book, is something called the widow's tax trap. And basically what it is people say, well, let's say you're married and you're filing jointly, right? You have the benefit of these larger, wider marginal tax brackets that are more favorable than the compressed brackets would be for those of a single person or somebody that filed their taxes as single. And so typically once, if you're a married couple and let's say your spouse passes away, there's usually only going to be, I think it's 1 year, a very short period of time where you still have the ability to use those joint brackets. After which you're going to be typically filing, unless you're remarried or whatever, you're typically going to be filing under the single brackets, which are going to be more compressed brackets, which means you can climb them faster and have different parts of your income that get taxed theoretically at a higher rate. So that's what they're looking at here. They're saying, hey, they were married filing jointly. They made pre-tax contributions when they were both alive using the joint brackets at a 24% marginal federal income tax rate. Now her husband's dead. Here's her situation. She's got $1 million in an IRA, $250,000 in a taxable account, $50,000 in a savings account, $3,000 a month to her face from Social Security, and here's what her tax return looks like. That's basically what we're looking at here. Okay, so on the next page, page 191, there's actually a table that goes through what this looks like. So here's what Estelle's 2025 federal income tax return looks like. All right, and then it's much easier for you to just look at it, but pretty much they list out the taxable portion of Social Security, which for those that don't know, the maximum amount of your Social Security retirement benefit under current law that could be subject to income tax is 85% of it. That's not an 85% income tax rate. It's just saying that up to 85% of what you're collecting from Social Security, worst case scenario, is going to be taxable. In this case, for her, that number from the $36,000 that she's getting, they're showing $30,600 of line item for Social Security. All right, she's at $3,400 of qualified dividends, $200 Section 199A dividends, $200 other non-qualified dividends, $2,500 of interest income. Her RMD, remember, was $62,500. So her AGI, her adjusted gross income, for those 6 sources, is just under $100,000, $99,400. So from that, she gets the standard deduction, which again, for a single person, $15,750. So that gets taken off. Then the additional standard deduction of $2,000, then a portion of, because there's income thresholds for this, and technically her AGI put her over a little bit, so there was part of a phase out here, but it's a share of senior deduction. The portion of the senior deduction, again, which is a newer thing with the OBBBA, comes out to $4,536 that comes off. Then she get a QBI deduction of $40. They should just leave that out, whatever. Okay, total deductions, $22,326. So of her adjusted gross income of almost $100,000, $99,400, we're backing out total deductions of $22,326, which leaves us with taxable income of just over $77,000, $77,074. So her federal income tax on that, $11,632. So her overall effective tax rate on her income is 11.10%. And they have a couple of other things they go through about effective tax rate for the IRA distribution, if you assigned all the tax to the IRA distribution, blah, 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 blah. I'm going to skip through that because without reading this and looking at it, it's a little bit confusing. Bottom line is, even though she is in the 22% marginal federal income tax bracket, if you look at what she actually pays in taxes, that $11,632, and divide it by what she actually had for her income or her adjusted gross income, $99,400, if you do the math on that, it comes out to an 11.10% effective tax rate. So they deducted when her husband was alive at a 24% rate, and even though she's in the 22% bracket, she's basically paying half of that in actual tax based on her situation. Pretty remarkable, right? So again, that would be a reason to, and a supportive reason of saying, hey, pretty good thing that she went ahead and made those pre-tax contributions to the retirement account at work. The next page, I'm not going to go through this, but there's a table that goes through the different pieces of her income, the type of income that it was, the rate she deducted it, the rate that it was taxed at, how much she paid, blah, 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 blah. It all boils down to the same thing. All right. So at the end of that, it says, in Estelle's case, her RMD is taxed across the 10, 12, and 22% federal income tax brackets. This illustrates a core benefit of tax rate arbitrage. Although she and her late husband deducted their contributions at a 24% marginal rate, the distributions are now taxed at lower rates, yada, yada, yada. Okay, so that's Estelle. Now, we're going to go through another example, and let's see. Okay, and this is the one, again, this is a situation that I personally would be more in line with worrying about. That's a very extreme example, but it still goes to show that, it's really not all that bad. So the second example, starting at the middle of page 193, says a $4 million traditional IRA, check. An 80-year-old widow subject to an RMD, check. The widow's tax trap, check. Income-related monthly adjustment amount, IRMA, check. All right, so this one is for Bethany. Bethany is a widow who turns 80 in 2025. On December 31st, 2024, her traditional IRA was worth $4 million. Using the IRS Uniform Lifetime Table, blah, 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 her 2025 RMD is $198,020, so $198,000. Bethany also holds a domestic equity index fund worth $1 million in a taxable account. Generates $15,000 a year of dividends, 13 of which are qualified. 1,000 of them are Section 199A, which is ordinary income, eligible for the 20% QBI deduction, and $1,000 of non-qualified dividends. She also has $50,000 in a bank account, earning $2,500 a year of interest income. Her Social Security benefit is $50,000 a year. Assume the traditional 401k contributions made by Bethany and her late husband, so once again, somebody subject to this so-called widow's tax trap, were deducted at a 24% marginal federal income tax rate. Again, that's basically the middle bracket, right? You have three under today's bracket. You got three below that and three above that. Okay, before we dive into Bethany's numbers, it's important to acknowledge that she's something of a unicorn. No shit. She has over $5 million in financial assets and very high Social Security benefits as an 80-year-old widow. All right? A $4 million traditional IRA, a $198,000 RMD in 2025 dollars are well beyond what most Americans planning for early retirement will achieve. Yeah, that's true. We offer Bethany's extreme example to help you evaluate just how challenging the combination of RMDs, the widow's tax trap, and IRMA might be. So just like they did before, we're now going to go through on page 194 what Bethany's 2025 federal income tax return could look like. So again, remember, she's getting $50,000 a year from Social Security. She's going to have a line item there for up to 85% of that, which is $42,500. Then she has her qualified dividends, her Section 199A dividends, non-qualified dividends, so 13, 1, and 1 respectively. Interest income, $2,500. RMD that we talked about, just over $198,000. Total adjusted gross income, or AGI, just over $258,000. Okay, so now from that $258,000, she's going to get the standard deduction, $15,750. The additional standard deduction of $2,000. In her case, because her income is over the threshold, she's completely phased out of the senior deduction, so her share of the senior deduction is $0. She gets a QBI deduction of $200. So total deductions off of her $258,000 AGI, total deductions are just under $18,000 at $17,950, which means her taxable income is just over $240,000. She will pay almost $52,000, $51,676 of federal income tax. She gets hit with the glorious 3.8% net investment income tax, which is only a nuisance of $665. She has to pay an estimated amount of $6,000 for IRMA, income-related monthly adjustment amount, for a total tax bill of $58,341. So her overall effective tax rate on her income, if you take that $58,341 that she paid and divide it by the $258,020 for her adjusted gross income, or AGI, is just under 22%. And again, remember, this is an absolute extreme example where most retirees are not going to have as strong of a situation as this. And even still, she's paying less now than she was able to deduct at 24% in this particular case while she was working. And based on the size of the accounts that she has, one could likely even make an argument that maybe even if anything above 24% makes this case that much stronger. Oh, well, for her to have those types of balances and those types of accounts, she must have been making a fuck ton of money. She probably wasn't in the 24% marginal bracket. She was probably in the 32% bracket. Okay, well, that makes it an even stronger argument. If she deducted at 32 and she's still paying effectively under 22, that's a positive 10% arbitrage there on that. So those are just two examples, just to give you guys an idea. These come straight from the book. Again, I'll put the link in the show notes. I'm not saying that's the answer for everybody, but the bottom line is, even if you have the perfect, storm, or, you're the unicorn scenario like they're trying to describe for this lady, it's still, in most cases, not going to be all that bad. Now, does that mean that everybody that makes a traditional contribution is going to benefit from positive tax rate arbitrage. No, and I think Cube Crusher said this on an episode a long time ago, but even if there was a situation where you experience negative tax rate arbitrage, let's say you did deduct at 24 and you ended up paying an effective rate of 25, so you're 1% to the bad. In his words, and in the words in this book, well, they don't say the fucking word in this book, but like, you're still fucking rich, basically. Like, it doesn't matter. You're still enjoying your life. You have maximum fulfillment, and it's really not that big of a deal. But in the vast majority of cases, by making pre-tax contributions to employer-sponsored plans, and based on everything we've talked about in today's episode and everything they've talked about in the book and everything that, I mean, there's different sources out there you guys can check out, but it really all bodes well for take the deduction today, and you're likely going to pay less tax in terms of your effective rate later. So something to think about. Again, this isn't about Roth IRAs. I think Roth IRAs are great. This is just when you have the choice between a pre-tax or a Roth contribution at your retirement plan at work, which one should you take or not? Again, we don't give any advice, but something to think about given the examples that we've given on today's show and how some of that stuff works and some of the logic that we've basically walked through. So it really did make me take a hard look at rethinking Roth contributions to employer-sponsored plans, and I kind of agree with them with their compelling 3, where for most people it's likely going to make sense to do the traditional pre-tax, use those tax savings to fund your Roth IRA or backdoor Roth IRA, use those tax savings to fund your taxable brokerage account, and give yourself some flexibility later. Because once you pay the tax, like I stupidly did back then when I was single and in the 32% bracket on an employer-sponsored Roth contribution, that's it. There's no going back. That tax has been paid. I was being a dum-dum, in the words of Cube Crusher, it is what it is. Since then, I've changed things up a little bit. So I hope that's helpful. If you guys have any feedback, comments, questions, as always, feel free to write into the show, realtalkpersonalfinance@gmail.com. Thanks for being here. We will see you in the next episode.
Check the mic and make sure it sound right, boys.